Top 5 tax tips every bookkeeper should know for 2024. My name is Zach Pasquarello. I own Harrisburg Bookkeeping. I have 85 clients. I've been running my own bookkeeping business for the past 4 years. I only do bookkeeping. I don't do taxes or payroll. I only do bookkeeping. So I don't do taxes. But as bookkeepers, I still believe that we should know a good amount about taxes. That way we can help our clients, we can advise our clients, and we can also know what to do for our own bookkeeping business. I'm not going to waste any time. Let's jump right into it. Top 5 tax tips every bookkeeper should master for 2024. I have to be honest with you, I started making this list and there's more than 5 just because I got super excited and my brain started going crazy. So stay with me. There's more than 5. Hopefully that's okay with you. Number 1, most important thing, keep business and personal transactions separate. For your bookkeeping, it's so much more organized if you just have your business transactions to sort through. Bookkeeping is the process of categorizing transactions. If you have to sort through business and personal transactions, it makes bookkeeping so much more unorganized, it takes so much more time, and much more likely to make mistakes. The number one thing I tell all of my current clients and potential clients, if they're mixing transactions right now, from today moving forward, do whatever you can to keep these things separate. You have to. It's the most important thing. Keep business and personal transactions separate. Quarterly taxes. If you're an entrepreneur, self-employed, you need to pay quarterly taxes, and they're due January 15th, April 15th, June 15th, and September 15th. For 2024, your first quarterly tax payment was due April 15th of 2024. And then your last one will be due January 15th, 2025. And then for tax year 2025, your first quarterly tax payment will be due April 15th, 2025. I don't do taxes for any of my clients, but I still understand these things so that I can help my clients. I can let them know. This will increase your value as a bookkeeper. It will make you seem more valuable, more knowledgeable. And also, it helps me because when I'm doing bookkeeping for my clients and on June 15th, I'll see a random $5,000 ACH withdrawal or check to the IRS, I know exactly what that was for. It was for quarterly taxes. You need to pay quarterly taxes for federal income tax and also state income tax. If you live in a state that requires state income tax, you need to pay quarterly taxes. Let me just add, I don't know anything about taxes. So all this information, purely educational. Some of this might be wrong. Some of this might be right. I'm trying to give you the best information I possibly can. From what I understand, now I recommend do your own research. From what I understand, quarterly taxes are based on the previous year. So for example, in 2023, if I had to pay $40,000 in federal income taxes, then my quarterly estimated tax payments would be $10,000 every quarter because of my 2023 federal income taxes. And if you have clients, recommend that they ask their tax accountant to help them calculate their quarterly estimated tax payments for next year. Quarterly estimated taxes, very important. If you don't pay them, the IRS will charge you interest, potentially penalties. So it's not the end of the world if you don't pay your quarterly taxes. You just might owe some extra interest. And you can go to the IRS website and you can figure out what that interest rate is. I think it's close to 8%. I haven't checked in a few months. I think it was 8%, might be more, might be less. Number 3, maximize deductions by identifying overlooked expenses like home offices, mileage. So I'm going to break this down. I'm going to go into a good amount of detail. So bear with me. Your home office, it needs to be used regularly and exclusively for the business. So for example, if you have your kitchen table where you eat dinner and you also have your computer, your laptop, and you do some work, that's not your home office because you're also eating dinner there. It needs to be used regularly for your business and exclusively. And all this information is great information that you can use as a bookkeeper to help your clients understand how they can optimize their taxes, and stay compliant with the IRS. There's two different methods for calculating your home office expense. Simplified option, which is just $5 per square feet, but not to exceed $1,500 per year. So if your home office is larger than 300 square feet, it might not make sense for using the simplified option. The other option, the regular method, here you take the percent of your home office with respect to your house. Just to keep it simple, to use round numbers, let's assume your house, 2,000 square feet. Your home office, 500 square feet. Your home office is 25% of your house. So in this example, you would take all of your expenses throughout the year for your house. Mortgage interest, real estate taxes, insurance, rent that you're paying, repairs, maintenance, utilities, everything for your house. Multiply that by 25% in this example, and that will be your home office expense, as long as that 500 square foot office is used regularly and exclusively for your home office. The other thing, your personal vehicle. You can use your personal vehicle in your business, and you can write that off as a tax deduction. The vehicle does not need to be in the name of your business. It just needs to be used for your business. The same concept as before with the home office. We're looking at the percentage of business use. So there's two options. You can take the standard mileage rate for 2024. That's 67 cents per mile. So if you're driving from your home office to the bank for business purposes, let's say it's 5 miles away, and then you drive from the bank back to your home office, that's a 10-mile trip. Multiply 10 miles by 67 cents. For that particular trip, that will be your tax write-off for the business use of your personal car. You need to make sure you have an accurate, updated log, a list of your trips, the purpose, the date, the distance. It can be pen and paper in your glove box. It can be an app on your phone. Doesn't matter. You just need to keep record of your trips. That's taking the standard mileage rate. The other option, take the actual expense. Same concept. Figure out what percent of my vehicle is being used for business versus personal. And then you're going to add up all your expenses: gas, oil change, repairs, tires, insurance, registration fees, licenses, depreciation. And you're going to multiply all of that by the percent you're using your personal car for business. Keep in mind, parking and tolls are deducted separately. Parking and tolls separate. So you can take 100% of parking and tolls incurred while you're on your business trip. And business meals. Meals are only 50% deductible in 2024. So keep that in mind when your clients are going out to eat with other clients, only 50%. Or if they're traveling, only 50%. Technically, if they're not traveling and not meeting with a business client, like if I live in town and I go to McDonald's because I want to grab a quick lunch and then I go back to my house, that's not a business meal. I have to be taking a client out, or I have to be traveling away from my home for it to count. But meals are only 50% deductible. Also, entertainment, not deductible. If I buy baseball tickets and take a client, even if I take a client to the game, does not count. Entertainment is not deductible. Solo 401k. Solo 401k. You can have a 401k as a business owner. Now, once again, I tell my clients all the time, like, I'm not a financial advisor. I'm not a CPA. I don't know what I'm talking about. I have done a little bit of research. I can give you some information, what I know, but I still recommend you reach out to your own CPA and your own financial advisor to get more information. But what I understand, you can have a 401k just like you did when you worked at Amazon. You can have a 401k as an entrepreneur. If you're a solo entrepreneur, you can have a solo 401k. You can have a Roth contribution or a traditional contribution. Roth is taxed now, not taxed later. Traditional, not taxed now, taxed later. The benefit of doing traditional is that it reduces your taxable income right now. So if I made $100,000 last year, but I contributed $10,000 to my traditional 401k, I'm only taxed on $90,000. But then in 30 years, when I retire and I pull that $10,000 out plus all the gains, then all of that is taxed when I'm 65 and I'm retired. The benefit of doing Roth is that you're assuming two things. One, maybe tax rates will go up in the future. Or two, maybe I'm going to be making more money in the future. If I make $100,000 this year and I make $200,000 when I'm 65, then I will be in a higher tax bracket when I'm 65. Therefore, I'll pay more money in taxes. So a good way to work around this is to just do a little bit of both. Have some Roth contributions, have some traditional contributions. That way you average it out, you get best of both worlds. I generally like to do Roth because I generally assume that in the future, I'll be making more money. I always plan on making more money in the future. So I generally stick to Roth contributions. Solo 401ks are great because they're not restricted on your income. Like if you have an IRA, you can only contribute so much and you can only get the benefit based on your income. Like if you make more than $240,000 per year, which I know not a lot of people do that, but there are some people out there who make more than $240,000 per year, you can't contribute to a Roth IRA and you don't get the benefit of contributing to a traditional IRA. With a solo 401k, you can contribute no matter what your income is, but you are subject to limits. I forget exactly, it's like $23,000 for the employee contribution, and then it's another, the math kind of gets complicated for the employer contributions, but definitely just recommend, just know as a bookkeeper, just know that there is an option for a 401k for entrepreneurs or a SEP IRA if they're not a solo entrepreneur. So just understand the options that your clients have just in case they ask you about retirement accounts or strategies for reducing my taxable income. If you contribute $20,000 to your traditional solo 401k, it will be a straight up reduction of your taxable income this year. So that's huge for a lot of people. A lot of people love that kind of stuff, and they will really value you as a bookkeeper if you're able to give them that information. Another thing I want to touch on real quick, just generally tax filings, really basic information. I'm going to orient you to the numbers and the words and the dates for common tax filings. Honestly, I did not know this stuff in the beginning, so I think it's important. 1040, individual income tax return. Everybody files a 1040 individual income tax return due April 15th. Partnerships have a 1065 due March 15th. S corporations, 1120S due March 15th. Quarterly taxes, already mentioned, due April, June, September, January. Sales tax, potentially due monthly or quarterly. I don't do sales tax for my clients. I try to stay away from it. Sales tax can potentially be incredibly complicated. If I do sales tax for a couple clients, all you need to know is what was their gross sales, what was their taxable sales, and then what state are they filing sales tax in. For Pennsylvania, I go to the Pennsylvania website. I just type in last month, client made $10,000 and $5,000 of that was taxable. So they're going to pay 6% times $5,000 sales tax for last month. Payroll tax, you got 940, maybe 941. Hire someone to do your payroll. I don't do payroll. Outsource your payroll to a local payroll company or to ADP or Gusto. And then 1099s are due January 31st. 1099s are due January 31st. I do help my clients file their 1099s. LLC to S Corp. You can change the tax structure of your LLC. We're not changing the legal structure of the LLC. We are simply changing the way the LLC is taxed into an S corporation. I generally tell people the benefits don't kick in until your net income exceeds roughly $40,000, but there's huge tax benefits for electing to be taxed as an S corporation because of self-employment tax, also known as payroll tax, aka FICA, or Social Security and Medicare. Social Security, 6.2% of your income. Medicare, 1.45% of your income. Now, the employer pays half and the employee pays half. So before, when you worked at Amazon, they paid half of that and you paid half of that for a total of 15.3%. So you're still paying 6.2 for Social Security and 1.45 for Medicare. But Amazon paid also that. So total 15.3%. As an entrepreneur, you are employer and employee. So you are responsible for the total 15.3%. If you're not an S corporation, 100% of your income subject to self-employment tax. That's huge. This is separate from federal income tax, local, state income tax. This is self-employment tax. Huge. I didn't know about this when I got started. If you elect to be taxed as an S corporation, now you're going to pay yourself a reasonable salary. I've seen anywhere from 40 to 60% of your net income, depending on how many employees you have and how involved in the day-to-day of your business you are, 40 to 60% of your net income. So now you're going to have your salary plus everything left over. So in this example, if you made $100,000, pay yourself a $40,000 salary, you'll have $60,000 left over in the form of distributions, corporate income, if you will, S corporation income, owner's distributions. Now let's look at an example. $100,000, LLC, not taxed as an S corporation. $15,300 self-employment tax. S corporation, same income, $40,000 salary, $60,000 distributions. Now only your salary is subject to self-employment tax. $40,000 times 15.3%, that's $6,120. You're saving more than $9,000 in self-employment tax, just changing the tax structure of your LLC. Keep in mind, for business owners, there is an increased tax filing fee and there are payroll processing fees. Because remember, I said there's an 1120S and you have to run payroll. You have to pay yourself a salary. So you're going to spend $50 to $60 per month processing payroll, and you're going to pay for an additional tax filing, the 1120S. Huge tax benefits. $9,000. Are you kidding me? That's huge. What's next? I told you this list goes on and on because I got so excited. This stuff gets me excited. If you're a bookkeeper, this kind of stuff should also get you excited. Like tax stuff, like this is exciting. All right, let's talk about misclassifying employees as 1099s versus W-2. So an employee, basically, huge gray area, maybe not, so many rules, so confusing. Basically, from what I understand, I could be wrong. In my mind, an employee is someone who you can tell them what to do, when to do it, how to do it. Let me use my trucking company as an example. If I give you a truck and if I tell you go over there, pick up that and take it over there and deliver it at this time, that to me sounds like an employee. But instead, if I have somebody else has a truck and they come to me, they say, hey, do you have anything available? And I say, you can go here or you can do this. Which one do you want to do? And they say, I like that one. Okay, go pick up that one then. And then here's, you know what to do, like go take it there. That to me is an independent contractor. I'm still paying the driver. I'm still paying the truck. But in the first example, it was my truck and I told him where to go and what to do. But in the second example, dude had his own truck. He was able to pick which load he wanted to do. And then I still paid him to do it, but he had his own truck. So that to me sounds like a 1099. Same concept with my bookkeeping business. If I hired a bookkeeper and I gave him a computer and I said, here's your 5 clients, here's what I want you to do, check in with me weekly, tell me how your progress is going, send them emails, here's your email, johnsmith@harrisburgbookkeeping.com, that to me sounds like an employee. But instead, if I have an independent contractor and he says, hey, like, can I work for you? He has his own computer and he asks for, like, I give him a client and he says like, okay, I'll do this bookkeeping, but I'm going to do it this way and I'm going to do it that way. And I'll send you reports now and then. That's an independent contractor. He's doing it on his own terms with his own equipment when he wants to do it. The big reason that this is such a hot topic is because if you have employees, remember what I talked about, S Corp benefits, payroll tax? If you have employees, you have to pay part of their Social Security and Medicare. And on top of that, you have to pay unemployment compensation and workers' compensation. Workers' compensation for dangerous jobs like truck drivers and roofers could potentially be 10%. That's a big deal. Unemployment compensation could be anywhere from 2% to 10%. Social Security, 6.2, Medicare, 1.45. You're potentially paying 20% extra because they're employees. Versus if you had an independent contractor, you as the employer, you don't have to pay any of that. The independent contractor is responsible for paying their own payroll tax. They're supposed to have their own insurance. I don't pay workers' comp for independent contractors. So big benefit for business owners to hire independent contractors instead of employees. So make sure your clients understand the difference. And then when do they file 1099s? How do they file 1099s? This is so important. This happens all the time. So many people get this wrong. Make sure your clients understand they have to get a W-9 from all of their subcontractors, all of their general contractors, independent contractors, even their vendors, even their attorney, social media manager, landscaper, bookkeeper, office manager, anybody who's providing services for that business. If they're not an employee, they need to get a W-9. The business owner needs to get a W-9 from the subcontractor. If they're paying them cash, check, Venmo, ACH, PayPal, Cash App, if they're paying them any way other than a card. If you pay somebody with a card, you don't need to get a W-9. You don't need to give them a 1099. But if you pay them any other way, you need to get their W-9. So make sure your clients understand that. I always ask my clients, hey, W-9 needed for John Smith. W-9 needed for XYZ Landscaping Company. Hey, I see you just wrote a check to this guy. Please send me his W-9. 99% of the time, they say, thanks for letting me know. I'll try to get it. But try to encourage your clients to get the W-9 before they pay them. Because potentially after you pay someone, you lose all leverage. They might never respond to you. They might never get back to you. You might not get their W-9. And you as the business owner, you are responsible for sending them a 1099. I send 1099s for my clients. I used to do it for free. I think I'm going to charge this year. It's kind of a pain in the butt process. You can do everything with QuickBooks Online. You can send 1099s straight from QuickBooks Online. You just need to make sure that you are recording the transactions accurately throughout the year. You need to make sure all of the transactions have a vendor, and then you can file their 1099s through QuickBooks. They're due January 31st. So January is a crazy month for bookkeepers because we're closing out the previous year and we're getting ready to do 1099s. A couple more things. A pre-tax season checklist, what documents to gather and how to review financials. So I don't have a list of documents to gather, but it might not be a bad idea for you to get a list of stuff that your clients might need. Or if you partner with a CPA or a tax accountant, ask them what list they have and see if they'll give it to you. And then you can send that to your clients and say, hey, here's what I recommend. Here's the documents that you might need. And then how to review financials. They need their profit and loss and their balance sheet. This is the responsibility of the bookkeeper. We categorize transactions, we reconcile accounts, and we generate financial reports. Make sure your clients understand they need the profit and loss. Give that to the tax accountant, and that's what they're going to use to file their taxes. Also, understand it's the business owner's responsibility to have accurate financial reports. Even if they hire a bookkeeper, the business owner is still the one signing their tax return. The business owner is always ultimately responsible for the profit and loss and the balance sheet. So what I do is I do my best to do everything correctly, and then I send it to the client. I say, hey, here's your 2024 profit and loss and balance sheet. Please review everything. Let me know if you have any questions, because it's their responsibility. It's our responsibility to generate the documents. It's their responsibility to review everything and make sure it all looks correct. 2 more things, I promise. Stick with me. I guess I'll mention real quick. If you're trying to start and grow your own bookkeeping business, I made a ton of resources for you. Go ahead, check them all out in the description of this video. I promise you, everything I made will absolutely help you start and grow your own bookkeeping business. I have a ton of stuff just for you guys. Check it out. 2 more things. Reconcile accounts. Make sure you as the bookkeeper reconcile everybody's accounts and make sure it's all accurate, especially at the end of the year. And not just bank accounts and credit cards, but also look at loan accounts, prepaid expenses, unearned revenue, payroll liabilities. Make sure everything on the balance sheet makes sense. It's the client's responsibility. It's the bookkeeper's responsibility. Work together. Make sure everything is accurate. Everything makes sense. Everything ties out. Make sure you reconcile all of the accounts. And then finally, depreciation. Let your clients know if they acquire assets throughout the year, it's not a write-off. If you spend $10,000 on a new piece of equipment, that's not a $10,000 expense in 2024. You have to record that as an asset. And then you have to depreciate that asset. I don't do depreciation for my clients because every tax accountant has tax software that will calculate tax depreciation for them. So it doesn't really make sense for us to calculate a book depreciation when tax depreciation will probably be very different from whatever we calculate. Most things have a 3 to 5 year lifespan. So if you buy a car, it's going to have a 5-year life. So if I buy a car for $50,000, I will be able to take straight line depreciation of $10,000 every year. If I buy some other piece of equipment, maybe it has a 3-year life. So maybe I spend $90,000 on a piece of equipment and it depreciates in 3 years. That'll be a $30,000 depreciation expense for the next 3 years. But there's also things like bonus depreciation, Section 179. So just do some research, be prepared to explain how depreciation works with assets. Big picture, most important thing, just understand that assets cannot be written off in the year that they were purchased unless you look into Section 179 and bonus depreciation. But generally speaking, they need to be put on the balance sheet and then they need to be depreciated by the tax accountant. So I know this was a long video. I know it was way more than 5 tax tips, but hopefully these tax tips and ideas and strategies help you be a better bookkeeper.